Our next guest thinks there is still time to invest for now, but watch out in the medium term. Joining us here at Post 9, Wolfe Research Chief Investment Strategist Chris Senyek. It's great to have you, Chris.
Yeah,
welcome.
Thanks for having me.
Sort of paint a picture of what the potential pitfalls are in the next 6 months.
Yeah, so there's a host of pitfalls, I think. I think the biggest one, foremost, is oil prices. I think the quickest thing that can cause the disinflation narrative to go away is higher oil prices, right? And that's the thing we're most concerned about because that feeds into inflation. It starts feeding in input costs. The other thing that we're closely watching is the dollar. The dollar weakness that we saw in some recent sessions, to me, was a potential red flag, given all the Treasury issuance that's expected to come over the coming quarter and two.
Not a delayed reaction to any kind of ratings action, for example.
No, not really. No, I think that the ratings actions last week was one of many indicators. I think markets were overbought. I think the issuance spooked the markets, frankly, the most. And then you had energy prices after their 3-week run pushing really hard and higher. So it was a confluence of factors, I think, kind of all and to what was an overbought market, right? So it was, we penned a piece the week before saying it was as good as it can get, right? And it felt that way.
What are your main concerns with regard to oil going higher? What do you think are some of the catalysts there? Because we saw inventories come out, didn't have too much of an effect. Demand from China seems to be pretty stagnant. So what is it that you're really worried about on that front?
I think it's OPEC. I think OPEC wants to put prices higher. I think one of the things that we underestimated this year was the impact of the Strategic Petroleum Reserve and how it put downward pressure on oil prices, by an extension gasoline prices, which helped the consumer, right? And that's why there's been upside surprises to the consumer so far year to date. And it feels like OPEC wants higher oil, and it's hard to mess with a cartel that big.
All right. We'll talk to Ed Morse later in the hour about his view. He's been maybe not as bullish as some. On the issuance thing and the impact on equities, would you expect it to hit mega-cap tech? And if so, can industrials and banks and some of the other materials names make up for that? Can there be an evening of some of these?
Yeah, so I think with respect to interest rates, it's twofold. I think rates move higher, long rates move higher over the short term into just a supply glut from Treasury issuance and into an economy that remains very resilient. I think as we get 6 to 9 months out, I think yields are going to be a lot lower on the long end because the economy is going to slow from the impact finally of all the Fed rate hikes. But it's happening at a much more slow and measured pace than something we've seen in the past.
So 10-year, I saw one target today, R.J. O'Brien, looking for 4.6 by year end. Does that make sense?
I think it's going to be closer to 3.6, if not lower than that at year end, because I think the economy is going to weaken. So I think we got to digest this issuance here over the next quarter. I think growth looks like it's going to be decent in the U.S. And then I think as we get to the back end, the issuance, is sort of on the back burner. The economy slows a little bit. Inflation kind of comes down a bit. And then you start to see yields come back in on the long end. And it's basically an economy slowing type of call.
Do you have a hard landing on the table at this point? Because that would suggest a pretty significant inversion.
So I think it's very hard to see inflation coming down meaningfully and a soft landing. So we're in the hard landing camp, but I don't think it hits till late this year, early next year. And in the meantime, it's really hard to fight this market momentum.